like, oh, everything's great, and the market's at higher highs than ever. The stock market, Chris, is the most overvalued in all of history. At the end of the greatest boom in history. And it's going to go down. I'm sorry. I hate to be realistic after being the most bullish person in all of history in the early 90s in the recession there and worldwide in the US and Australia that said we're going to see the Dow 10,000 by 2000. People thought I was nuts. No.
Hey guys, welcome to the channel Market Uncharted. Today we have an important video to see, which is the potential market crash and how we as an investors need to travel this potential market crash. How can we be prepared for it? What we need to do after it so we can take full advantage. And why this is important? Because as you've seen last year with the COVID and the market crash around 25 to 50% on the stock exchanges, the world is not going to end. We are always coming back stronger, faster, and with more technology to help us as an investors to make more money. So instead of being afraid of it, we need to embrace it, be prepared of it, and understand that in economy, a healthy economy needs to have boom cycles and crash and depressions. Okay, this is how it works, and this is how it maintains the economy healthier. So let's see a few signs of a potential market crash that are now appearing all around the world, and we need to be aware and prepare ourselves to face it. First, vaccine efficacy hype misses the mark. Not enough people receiving the COVID-19 vaccine. COVID-19 variants accelerate a new round of shutdowns around the world. The US 10-year bonds had a sell-off with the treasuries yields really increasing. Additional stimulus is on the table. We are talking about a new stimulus check to the economy, new infrastructure bills with trillions of dollars being injected in the markets, loan and credit delinquencies overwhelm financial institutions, share buybacks continue to decline, stocks are historically expensive. Emotions get the better of investors, which means when we are seeing a stock crash, we immediately sell to go out of the market. History repeats itself because this has happened in the past. Real unemployment rate is still uncertain. Huge discrepancy between real economy and the financial economy. You have a real economy with a lot of unemployment, yet the financial markets are on all-time highs. The housing market bubble, for example, Australia, everything bubble with the increase of bubbles in NFTs, cryptocurrencies, everything is really well and historically expensive. So let's see also, I strongly encourage you to research about the Buffett indicator, and just to put things into perspective, the so-called Buffett indicator has hit another all-time high. Global stocks now worth equal to 123.4% of global GDP, and so moving further and further into bubble territory. So you need really to be careful of what's going on right now in the financial markets. You see there the Buffett indicator really already above what happened in 2008. You see it, it's out there, it's visible in the graph. So don't be scared, just be attentive, assertive, and expect volatility. Then how to prepare yourself, right? In the same words as Robert Kiyosaki, one of the best investors in the world, buy gold, silver, and cryptocurrencies. Why? Gold historically in every downturn suffers less than the markets. For example, in the COVID-19, gold went down 20% instead of 50% of the stock exchanges. Silver always goes down more than gold but quickly picks up. And why is that? Because soon as the depression hits, the financial markets all go down, gold and silver included, but then the investors flee back to safety, and gold is a safe asset. The same for cryptocurrencies. Of course, cryptocurrencies are still young, 12 years for Bitcoin, so we don't have yet full information, but I will give you again an example. In the COVID depression, Bitcoin crashed down a lot as well, but 1 or 2 months after already almost recovered everything. So you see that Bitcoin has a possibility of, although it suffers, it quickly comes back way faster than the financial markets. And all of this, you also need to have at least 20% of your portfolio in cash just in case if something happens, which means you start having your portfolio with your stocks, it's okay. Then you put your gold, silver, and Bitcoin percentage of your portfolio plus 20% in cash. Why? Because, in my opinion, and this is just my opinion, a crash is the best sale ever. Imagine your favorite asset. It can be an iPhone, it can be a TV, it can be a PlayStation, whatever, or a car. Imagine that asset. If the guy shows at your door and says, "Look, today you have 50% of discount," what would you do? You would buy it, right? This is exactly the same. Let's imagine Netflix, Google, Nvidia, Zoom, PayPal, Salesforce, whatever, Amazon, whatever. If a stock market crash, these stocks will have a discount. It will be amazing to buy. So put yourself cash on the side to be able to buy these type of companies. You have here, these are my favorites: Tesla, Palantir, Roku, and Zillow, for example, for my growth companies that I still have. In this case, in the words of, for example, Cathy Woods, she thinks these are deep value stocks, right? But for us, in the future of 5 to 10 years, for now they are still growth stocks that you can put your money on the side. You see now they are actually expensive, but in the case of a stock market crash, you can get a discount on those. Also, for example, these are the most profitable American companies in the world, well-known names: Berkshire Hathaway, Apple, Microsoft, JP Morgan Chase, Google, and Bank of America. They are just one of a few examples. For a cashless society in the future, the same type of companies, Square, PayPal, Apple, Affirm, that are still with a huge price right now, but in the way of a correction, would be a discount, a bargain. Then also divide the between what is a growth stock, value stocks, blue chip, and dividends. But again, these are one of a few examples of amazing companies out there. I would strongly suggest you to right now do a potential portfolio. Just call it like a crash portfolio. The most amazing companies that you would wish to buy, for example, but for now you think it's still too expensive. So make it out there and analyze what's going on in the macro environment. You would see that there is a lot of volatility out there. There is potential bubbles out there that, if they burst, will impact the financial markets. And when they do, you can take advantage by investing in one of the biggest brands in the world at discount. More examples, because again, you need to divide if they are growth, dividend, etc., and check the risk of them as well, because it's important. You need to adjust this to yourself. What is your risk profile? In my opinion, in a stock market crash, I would immediately jump on the high risk stocks, for example, Tesla or Square, Shopify, even Bitcoin, because I know they have the really good potential to growth, and I like volatility, and I have a risk appetite really strong. But for example, if you don't have, you can go for the low risk ones like Walmart, Procter and Gamble, Johnson and Johnson, or just the ETF that follows the S&P 500, the SPY. In the middle, you have Apple, Microsoft, Visa, Disney. These are really amazing companies, right? So be aware of this, address it. study, research, conduct already your crash portfolio, that if it happens one day, the companies that you would immediately jump in and put money on the side to be able to buy these bargains. So thank you guys for watching this video. I hope you have enjoyed it. Please share and subscribe the channel for more content. Don't forget that knowledge is not power, knowledge is potential power. Execution is everything. Please feel free to add more companies to the ones I show you. It was just an example. These are just the ones I really looking for to be able to buy one day. And don't forget, just like the markets, we will not rest.
My question is, with what I'm starting to think of are maybe some long-term headwinds, whether it's taxes, regulation, rising interest rates, whatever you want to call it, where we may have passed a second derivative on some of those things. You think we come back from that correction to new highs, or could this be a time where maybe we pause after an unbelievable advance these last couple of years?
Yeah, Joe, I definitely think we're going to get a correction. And I think it's just going to be really hard to call whether that's now, spooked about yields. I guess I kind of think it might be a little later this year after more people are vaccinated and we're extremely giddish on both Main Street and Wall Street about being able to roam freely and opening up businesses again. And that could come a correction from higher levels than we are now.